Good afternoon, ladies and gentlemen, and welcome to our webinar today. My name is Navina and I represent Capital Markets Malaysia. So today's webinar is brought to you by the Sustainable Investment Platform, which is a collaboration between Capital Markets Malaysia and the Institutional Investors Council of Malaysia. And the title of our webinar today is Applying ESG Datasets, a primer for asset owners and asset managers. We have three great speakers joining us today from Malaysia, Japan, and Singapore. And the session is only going to take an hour, so there's no breaks in between. We'll go straight through. And because we only have an hour, I'm not going to say very much. I'd like to just get into introducing the first speaker. So the first speaker today is Arina Kok, Partner for Climate Change and Sustainability Services for EY Malaysia. Arina is going to speak about a comparative view of the ESG data landscape. So Arina, over to you.
Thank you, Navina. I will share screen and please let me know once you can see my screen.
Yes, I see your screen.
Thank you. So if I may, I'm just going to quickly kickstart the session today. I will cover the environmental, social, and governance data provider landscape. Navina, if there is a need for me to, if there is disruption in the voice, you can just let me know.
Sure.
Okay, thank you. So I'll kickstart. I only have 8 slides. So I will take the next session to focus. Now, when we talk about ESG data, companies we're seeing in the market, companies are really identifying the right use cases, how they're going to apply ESG data to influence decision making and meet sustainability commitments. These are the 5 focus when they look at ESG data. The first one is on ESG score. Companies have leveraged vendors to evaluate their ESG scores relative to peers and initiate target projects aimed at improving their ESG score, as well as the top 10, for example, focusing on the top 10 shareholders' ownership and get their stated objectives. This is in order to ensure that they are also very much aligned with their shareholders' objective and directions. Second part is we are also seeing companies looking at raw data and analytics, applying that, for example, looking at emissions data, physical locations, and green products, and are developing their own internal methodologies to enhance the internal risk ratings, underwriting, and pricing, and also looking at credit assessments processes to support their clients or counterparties in their transition to a low carbon economy. So this is very much for banks, asset managers, and insurance as well. The third one, what we're seeing is on climate risk modeling and stress testing. Now this can apply to a wider sectors, especially the sectors that are under pressure to decarbonize. So companies have been sourcing or have sourced client or counterparty data such as geospatial data, replacement value, temperature alignment scenario models, whereby there are references to get data from IPCC, Intergovernmental Panel on Climate Change, and also NGFS, Network for Greening the Financial Systems. Now, what we have seen in the market is for some scenario or climate risk or stress testing that is being done, there will be certain data that IPCC will provide, but may not, there would be some data that you can't get and you have to go to NGFS. So there will be a mixture of myriad of available data. So the key thing is to understand what each of this provides and then build up as you go on to leverage on ESG data. Now, number 4 is having the ESG data. It's very important to also ensure that there are disclosures and commitments that come with it to actually bring a meaningful conversation. So most companies who are also looking at how to disclose ESG data in a meaningful manner, they would then also have data sources and look at how these sustainability reporting is communicating their, for example, net zero commitments, target setting methodologies. For example, if they're setting a sectorial decarbonization approach from public or ESG vendor sources, those are the sources that they would gather from. 5th is on sentiment analysis. Now, what we have seen is companies have also used big data, and this is where the advancement or the future of ESG data would come in and be of a use case. companies have used big data and machine learning to analyze social media output, media coverage, and analyze reports to actually determine how their brands are portrayed with respect to ESG factors. So what we are seeing is, on top of this, a lot of ESG data eventually in the near future will be monitored on a real-time basis, and some of this sentiment analysis will be a strategic tool for the company to sharpen and respond to ESG material matters management moving forward. Now, these are the 5 considerations. The next slide, if I can move on to the next slide. Now, when we talk about ESG data, there are different levels of maturity within a company on how they actually get or source data. So from the very high first line on the basic, we'll see companies who buy single data sets from a single provider or limited data feeds from a few different third-party data providers to meet basic regulatory expectations. Moving down, the next tiering are intermediate. What we see is across the middle of spectrum, there are companies using several different third-party data sources to meet a range of data needs. So as the company gain a better understanding of which type of data serve different requirements, they look to use multiple data sets and integrate multiple ESG considerations across business functions. The third one is where it gets onto the more advanced category, whereby more progressive firms are more actively engaged in risk management and seeking out the commercial opportunities, while market leaders in this space are driving innovation, spearheading collaborative initiatives around the creation of alternative reporting metrics and the harmonization of ESG data taxonomies. So based on experience, some of these organizations, we've also facilitated, for example, in the discussion with World Economic Forum, to come together and align what are the common matrices on ESG. So some companies who are at the leading stage have already been engaging to provide their feedback on where these data are important, and it would be something that they are also keen to report. Now, everyone would head towards the intended ideal stage. The ideal stage, or where the ultimate target state for all companies, is to have an integrated ESG data model that uses a consistent source of ESG data for all use cases, and developing this internally requires significant investment. So to a certain extent, it has to have a well thought through process on how to integrate the various data sources so that there is one single source of truth, and that single source of organization, whether it is for your investment purposes, whether it's for your underwriting purposes, or whether it's for your other collaborative discussion purposes, there is a single source of truth when you come to the ideal stage. So as we move on to understand the next deep dive on the complexities of data selection, we have outlined here from the perspective where financial services, they do face a range of challenges when it comes to understanding ESG data and how third-party providers can meet their needs and consideration when they make vendor selection. So if you look at the ones on the left first, now, all models apply simplified assumptions and therefore reduce the relevance of results. Now, these are one of the challenges. For example, they may not capture mitigating actions already taken by firms or their adaptability to change. Now, conversely, the larger model, the less transparent it is, and the harder it is to perform a full sensitivity analysis, and the harder it is for analysts and policymakers to interpret its results. So the key is to find a model which best represents the business, industry, or market which you are trying to model, and enhance the results with out-of-model adjustments to tailor it to each firm's individual situation. Now, this is interesting because to a certain extent, there will be a need to have direct engagements with the company because company may not tell you the full picture of what they're actually doing. So the next part is there is no silver bullet that covers all ESG data needs. Some firms will offer a suite of tools that cover multiple use cases, but many are focused. So it is highly likely that you will need more than one data provider to fulfill your ESG data needs. Now, to achieve efficiencies, there's a need to avoid duplication across providers, as well as assess where a single data set can be deployed across a number of use cases. Lineage data mapping tools can be used to support this. Off-the-shelf models do not accurately capture tail risk events and uncoordinated or delayed policy actions. Now, it is important to understand the limitation of your model and apply actuarial judgment to ensure that significant tail events are accounted for. So if we move on to the right-hand side, most data or modeling providers are not an out-of-the-box solution. For example, climate scenario modeling may provide you with a metric such as climate value at risk, CVAR, that's commonly considered, or cost of carbon, but these data outputs still need to be integrated into the risk management framework. So the CVAR will need to be translated into a probability of default, and this in turn will need to be translated into balance sheet impacts. So that correlation and connectivity needs a certain level of refining, and it will not be something that without these tools you can actually come up with it. So the next part is not all providers will cover the full spectrum of risk, and this is where there will be clear recognition. Some focuses only on environmental aspects, while others will look at environmental, social, and governance risk, the ESG risk. Within the environmental matrix, many focus on climate and do not capture broader biodiversity risk, which are becoming increasingly important. Some modeling firms may focus only on physical or transition risk, and some consider both, but the scope of physical risk covered will vary. So a separate qualitative analysis of litigation risk may also need to be considered, as this can be significant. So the aggregation of data is not always transparent. Understanding data inputs, assumptions, and limitations is essential to understand results. For example, some rating firms will outweigh particular ESG teams, and you will need to determine whether these are material to you. Some rating firms also calibrate their score with sentiment analysis, while others do not. So if we look at this EY ESG data provider analysis and landscape survey, these are the results. It outlines the various data solution and the percentage or the number of data providers offering this type of solutions in the market as we speak. We can see the tiering or the color of regulation coverage, SDG alignment, data coverage, which has the ESG scoring, indices, raw data, supply chain sentiment analysis. There is also the modeling coverage, considering the net zero, climate risk modeling, stress testing, and biodiversity. So this outlines how many data providers are there and how many will be available in 2021. On the right-hand side, you see that on data solution, while the majority of data providers specializes in 1 to 3 types of data solutions, whether it's scoring or raw data, there are some data providers offering the whole range of ESG data product types. So these are the number of data solutions and offered. This actually outlines. And when it comes to the commercial model, the pie chart at the bottom, most data solutions can be bought via licenses, whereby the fees differ depending on data usages. 6 of the analyzed data providers offer their solutions as open source and offer for-fee implementation services. Now, this graph outlines the split of the percentages, those with license per data set, bespoke pricing, open source, and no information. So when we come about what the asset managers uses, there are a range of different ESG data providers. For example, with MSCI, Sustainalytics, Truecost being the most widely adopted. In the analysis that we have, we've looked at 62 asset managers across EMEA and the US on their ESG data provider usage. On the left-hand side, it outlines the number of different data providers used by asset managers to cover their ESG data needs. So the majority of asset managers analyzed use between 2 and 5 different ESG data providers. We also see some asset managers using up to 10 different ESG data providers to be able to integrate ESG into their business. On the right-hand side, we've also outlined the number of asset managers that use single players in ESG data provider market. Now, if you look at the graph, here it also outlines that MSCI is used by 52 out of 62 asset managers analyzed, and therefore is the provider that leads in the WAM ESG data space. MSCI is followed by ISS ESG and Sustainalytics, which are used by 35 asset managers in our analysis respectively. So coming to the slides that I have, here we outline the last slide that I have. Here we outline the 4 key steps which will help asset managers or asset owners to get the greatest value from external ESG data. The step 1 of our 4 steps is internal and external ESG data assessment. First is to pull together the use case from different work streams to understand and centralize the requirements. Second is to implement use case, prioritize based on collected requirements. Look at the internal and external data sources to see what best fulfills data needs for prioritized use case, and select the ESG data vendor assessment for compliance with data security and privacy requirements. Step 2, when looking at data sourcing from select vendors and internal sources and gap assessment, the considerations would be to identify any gaps and supplemental data needs, identify additional internal or external data sources to fulfill the supplemental data needs, identify potential data qualitative challenges, and identify data transformation needs. Step 3, ESG data integration strategy and roadmap development is to build an ESG data strategy in alignment with enterprise data management policy, develop a roadmap to integrate ESG data sources into existing data ecosystem for prioritized use case. ESG data integration should also align with your enterprise data management policy with a focus on data quality and transparency into the data supply chain. And lastly, on step 4, on ESG data integration execution, focus is to source the data and ingest the data sets from selected vendors for prioritized ESG use case into the enterprise data ecosystem, use existing data ingestion patterns and tools as necessary for ESG data sourcing based on vendor infrastructure, define and apply preventive and detective controls to maintain the enterprise data quality standards on data sourced from ESG vendors. This is very important because as you go through this various journey of actually getting data, you will notice the quality data may vary. You may need to go back and forth to test the quality of data that you have. The next is to utilize existing regulatory standards as guiding principles to meet evolving regulatory needs. Transform your data based on consumption use cases and to ensure compliance with data security and privacy requirements. Consume ESG data from authorized provisioning points in a unified data layer across the enterprise to ensure consistency. So I think as you go through these 4 steps, you will recognize that within an organization, there will be different data providers, data users, and data analysis or analysts that will actually need to come together within the data ecosystem to work together to build and refine, understanding where the gaps and the qualities are. And there will be a need to have a feedback loop to also progress as you enhance on ESG data integration. So this is where I have completed the sharing session. Of course, not to take the thunder away from the rest of the next participants. So maybe Navina, I will hand over for the next presenter.
Sure, thank you, Arina. We do have a question, and I think it's something that Justin and Sylvian can also address, but I will read it out to you, Arina, and see if you have any thoughts on it. So David is asking, how reliable is the data being collected by external third parties, where the company itself doesn't have the type of data collected internally? So do you want to weigh in on this? And I will also ask this of Justin and Sylvian later.
Yeah, so I think the question is how reliable are data collected by external third party? Historically, in our work with the third party data providers and the users of the data, which could be a bank or an insurance, data collected by external party is as good as what the company report. So there are challenges because even if they report, for example, emissions, there are gaps in terms of whether it has covered all geographical locations, whether it has covered the supply chain, whether it's only for property construction, for example. They may only have emissions for completed building, but not construction phase. So you will see that those are the clear data gaps, which naturally companies are moving to enhance these data sets as well. So the way is to understand when you use the data, where are the boundaries, where are the quality and the limitations. And then as part of the strategy, if it is a significant data set, they would start to do sample assessment or engagements with the company directly. So that will help to refine the process. Maybe I'll let Justin weigh in as well.
Okay, all right, great. Thanks so much, Arina. Thank you for joining us today, and thank you for that comprehensive landscape overview. So next up, just before I introduce Justin, I'd just like to say that the slides that Arina has shared will be made available on our website, and we'll send the link to you after the event. So next up, we have with us Justin Wu, who's dialed in from Tokyo. Justin is head of Asia Pacific for Bloomberg NEF, and he'll be walking us through a presentation called Net Zero Pathways Evaluation and Assessment. So Justin, over to you.
Great, thank you, Navina, and thanks, Arina, for the. Actually, I was going to say that your answer is perfect. I don't have a lot more to add. I fully agree that no matter who collects the data, it is as good as the companies that actually disclose it. And actually, that's one of the biggest challenges out there right now is whether we have a standard for disclosure. And that's one thing. For instance, the TCFD tries to do is actually trying to standardize disclosure amongst companies around the world. So obviously that's one of these things that we need to watch very closely is whether a company is a TCFD supporter. So usually those that do sign up for it, you can at least be sure that they have some level that they're working towards in terms of the data disclosure. So that's one thing to look at is whether the types of standards or groups that they sign up for their disclosures. So it was a really good question though. But let me get to my presentation and I'll just put my screen up if you just give me one moment here. So one thing at Bloomberg that we do is actually not only sort of look at not only sort of have data and look at data, but we actually try to analyze trends for net zero and decarbonization to actually understand, what are the things that are happening and what that actually means for investors, asset managers, and for the companies themselves. What are the opportunities and gaps in the market, and what are the strategies that various players need to take in order to thrive in a net zero world, if you will. So for my presentation today, I'm going to walk you through three major areas. First, I want to take a look at decarbonization trends so far. So where is the world right now in terms of our pathways? I'll talk a little bit then about companies and net zero targets. So what actually makes a good net zero target from a company, and what do we observe from companies that actually have set these net zero targets so far? And then finally, I'll share some thoughts about in the specific context of Southeast Asia. So what are some opportunities and challenges, particularly for companies and for the wider region in general for Southeast Asia? So to begin with, I think one thing that we tend to think about, when we think about the last 2 years is obviously the pandemic. That's the biggest news that everybody cares about, talks about, still very much ongoing. But actually the other major story that perhaps is a bit more optimistic is the fact that net zero as a concept has become a global priority. It's become mainstream. So on the eve of COP26, 90% of all emissions in the world are covered by some sort of net zero target. So that's, obviously almost most of it in the world. If you look back just 2 years ago in January 2020, less than a third of that was covered. And most of that were really in countries in Europe or smaller countries. It didn't include any countries in Asia, much less in Southeast Asia, any of the emerging markets in Southeast Asia. So this was a very big change that took place. But obviously, this is something that happened in the last 2 years, but the energy transition or the transition to low carbon technologies has been ongoing for quite some time. If you look at investment trends over the last almost 20 years, what you notice is that things have been picking up quite a bit, especially in the last 10 years. And last year, about $500 billion was invested in energy transition or clean energy technologies around the world. So this is a record number. And obviously, it's been quite a significant increase since 2004 when we started tracking this number. The majority is in the portion in yellow, which is in renewable energy, such as wind and solar, et cetera, but a growing portion now in electrified transport, such as electric vehicles, and also supporting infrastructure. So obviously one of the reasons we're talking about net zero becoming a possibility, and perhaps why so many countries now believe that it can be achieved, is the fact that renewables now are the cheapest source of new power generation for the majority of the world, including for some countries in Southeast Asia, not for every single one, but some notable countries in Southeast Asia, like Vietnam or Thailand, for instance. So in some ways, when all these countries are trying to build new electricity sources, they see that either wind or solar is the cheapest source versus going for fossil fuels. So that's been a very dramatic change since in the last 10 years or so. Another technology that's very important for our decarbonization efforts is electric vehicles. And actually, as of last quarter, about 10% of all passenger vehicle sales in the world are now electric. So you can see that actually in the last 2 or 3 years, this, it was in single digits, 1 or 2%, and this has grown very, very quickly in that regard. We look at some trends in investment and finance. Another very notable milestone, if you will, or indicator is sustainable debt issuance. And this has obviously been in the news quite often, but it is true. So over $1 trillion of sustainable debt issuance was issued as of the third quarter of this year. So $1 trillion just in the third 3 quarters of this year. So that's a significant uptick even just from a few years ago. So clearly this is an area that every company wants to become a part of in some ways, and it's an emerging, growing trend. Another area is also in new technology. So actually, to reach our net zero goals, we can't just rely on the current technologies that we have today. The investment there will be next generation of technologies that need to be developed and scaled to actually hit our decarbonization goals. So venture investment is another indicator of this, and this has also risen to record levels this year. So in this year alone, almost $40 billion US dollars invested in venture technologies related to climate as of September this year. So the number will probably go a bit higher in the last 3 months of this year. And finally, as I mentioned just before the presentation about TCFD, so one of the, probably now I would say one of the mainstream indicators of disclosure, or mainstream sort of standards of disclosure. So the supporters for the task force on climate-related financial disclosures has reached 2,550 members as of last month. And that's up from only 100 members in barely 3 years ago. So this is something that's really taken off. And obviously, with this type of increase in support, we can expect to see a lot of more data and disclosure from companies. So hopefully a positive sign. So having said this, this is sort of where we are now. What does it mean for a company, right? So how should a company think about opportunities and risks associated with these trends? So one example I want to mention is you may hear announcements from various companies. For instance, General Motors, a major car manufacturer in the US, but similarly, you can look at Asian car manufacturers, European ones as well. So they've done basically 2 things. One is that they have pledged to make all its global operations and vehicles carbon neutral by 2040. So what that means is actually, yes, we have to decarbonize our own operations and also, sort of comply with the trend towards net zero. So that's what the company itself. But the second, often more, so that sort of gets you a good ESG score if you were measuring that. But what that doesn't really always tell you, and probably what's more important, is that will this company still thrive in a zero carbon world? So I can eliminate all my emissions, but if I'm still selling gasoline-powered cars in a net zero world, obviously I'm not going to sell a lot of it because people switch to electric vehicles, or we can't sell emissions generating vehicles anymore. So the other target it's set is hit this, which is selling only zero emissions models by 2035. So I think in some ways there's 2 parts to look at. One is the company itself, its emissions, its ESG scores, but secondly, is its business model going to be compliant in a net zero world? And that's something that we actually spend quite a bit of time thinking about and working with companies and investors on trying to understand whether their business models are actually going to be compliant in this type of environment. for most companies, there is immense pressure actually to keep up with net zero goals or to beat their peers. It's a very easy example to illustrate this. So just in the span of about 2 years, we looked at 3 major sectors: financials, oil and gas, and utilities. So obviously, oil and gas and utilities are energy companies. They're major emitters, the largest in the world. Often the surge in net zero commitments is driven a lot by healthy competition. So one company would make an announcement, and suddenly you have everybody, all its peers sort of piling in as well. So the oil companies has started only in December 2019, but now you have 18 oil and gas companies, which cover a large swath of emissions around the world, of global emissions, now also pledging net zero goals, and also becoming more ambitious, pledging sort of scope 3 as well. Similarly, in financials, this only kicked off about 1 year ago with JP Morgan, but soon all the major banks around the world also made these net zero pledges as well. But you take a look, it's a little bit of a complicated chart, but just a few simple points on this. If you take a look at actually net zero targets, the majority as they stand now are actually not good enough, right? If you analyze companies and look at their net zero targets, there's usually 2 issues. One is that either it's not enough reductions per sort of revenue, so that's sort of the vertical axis, or similarly, they're not ambitious enough. They haven't set targets that for instance, cover their supply chain or can sort of decarbonize within the time frame that they set, etc. So there's a lot that hasn't really been sort of there. So quite a bit of room for improvement. Perhaps unsurprisingly, technology and consumer-facing companies, they tend to have smaller carbon footprints, but they have set some of the most aggressive or ambitious targets, and partially because probably they're client or consumer-facing. So that's one reason they want to sort of show that they're doing something and they're leaders in the field, etc. So what actually makes a good net zero target, right? And there's a lot of things that go into it, but I think maybe 3 sort of elements for you to think about. One is that, and I mentioned this as well, is covering your entire value chain. So scope 3 emissions. So not only the emissions coming from your operations or production of your goods, the emissions that also come from the consumption of your product. So nowhere is this more important than oil majors, for instance. So most of the European oil majors at this point have set what we call scope 3 emissions targets. So not only covering emissions resulting from the generation or the production and refining of oil and gas products, but also from the consumption of their products as well. The second point is actually setting interim goals. We can set a 2050 target, but that's 30 years from now, right? How do you keep your investors and also your regulators informed of your progress? That's interim goals. So set a 2025 goal, a 2030 goal, so people can track your progress, right? You can see actually whether you're actually making the right moves towards the goals and targets you set. And actually, utility companies are, as an example here, are generally been pretty good at doing things, setting interim goals towards their final target and communicating this with their investors, so that's all very, very clear. And finally, it helps to be an early bird, as they like to say, set a goal before 2050, right? So being a little more ambitious in this regard, or being able to pull yourself ahead often helps as well, and gives you a bit of a buffer and space for getting things done. Of course, it's not something that every company can achieve, but certainly for the ones that can, for instance, tech companies, as I mentioned before, being extremely ambitious on this front, are the ones that have set net zero goals, for instance, by 2030, 35, etc. For reference, actually, Bloomberg, the company that I work for, we set a goal for 2025. Obviously, I think our emissions are a bit lower than some of the energy companies out there, but nevertheless, I think we've tried to be very clear about this and sort of being ahead of the goal. So as an example, again, different companies may take different paths towards this, but it helps to sort of create a bit of a buffer on that as well. So my final bit here is just to highlight a few examples about Southeast Asia. So what I've shown you so far are global trends. As I mentioned, net zero is a global trend and has come to Southeast Asia as well. Specifically, if you look at the 6 largest economies in the region, so Thailand, Vietnam, Malaysia, Philippines, Singapore, Indonesia, where are they? Well, roughly it's easy way to think about this is, a third. So Thailand and Vietnam have actually done the most in terms of setting an official government position for carbon neutrality or net zero emissions by 2050, and have begun to sort of introduce legislation to illustrate how this can be achieved. The next tier down would be Malaysia and Indonesia, which governments have essentially set a goal. So the Prime Minister in Malaysia have announced an ambition ahead of COP26 for carbon neutrality, but currently still needs to sort of draft the legislation and put in the how of doing it. And then one down is Singapore and Philippines, actually, which in the case of Philippines, no net zero carbon neutrality target set. In the case of Singapore, actually, it's something that's set for the second half of the century, after 2050, which would make it not actually compliant with our climate goals. But so, that's why we sort of consider it a bit different from the others in the region as well. Nevertheless, despite these good intentions, we have to remember that we're still dealing with mostly emerging economies in this region. So even with these targets, by 2030, it's very likely that all 6 of the major Southeast Asian economies will see at least a doubling, if not a tripling of their emissions. In reality, it might not actually grow to the levels that you see on this chart, but nevertheless, it's on an upward trajectory. And that's something, obviously, that's going to make it much harder for countries to reach their goals if this is the trend. On the finance side, if you remember that we've reached about $1 trillion of sustainable debt issuance as of about September 2021, while only $33 billion of that is Southeast Asia, still a tiny amount, obviously, less than 5%. But still, you can see that it was even smaller 2 years ago. So this is sort of, again, on an upward trend. And then in terms of disclosure, as I mentioned, out of the 2,000 plus companies that are part of TCFD, 109 of them belong to Southeast Asia. More than half, about half of them actually are headquartered in Singapore. So again, still growing, moving in the right direction, but still very, very early days. On the disclosure side, again, this is probably going to be the biggest question that everybody thinks about. We're only going to be as good, all the analysis and everything we do is only as good as what the companies disclose. And obviously, this is really important. Less than half of the 300 largest companies in Southeast Asia so far have disclosed their greenhouse gas emissions last year. You can see that, in the different sectors, obviously the higher emitting ones like energy or utilities, or materials, industrials have actually, done more than half of them have done some sort of greenhouse gas emissions disclosure. But some of the lower emitting ones like banks or food and tobacco, real estate, et cetera, have done a lot less. So there's obviously quite a bit of room for improvement there as well. Similarly, on net zero commitments, there's only a select number of companies in Southeast Asia that have actually made net zero commitments. But the good news is that actually it's across a diverse range of sectors. So everything from the energy companies, industrials, banks, food, real estate, et cetera. So actually a good variety of them. But there are some challenges with this that we have to highlight. So as an example, and I won't get into it too much here because of time, but if you look at, for instance, the different sectors of companies that have done disclosure so far, here we have oil, gas, and consumable fuels. There's 2 things that you'll notice. One is that very few of them actually have disclosed scope 3 emissions. They've only done actually scope 1 or 2. So nothing around the emissions associated with the consumption of their product, as you can see in the middle chart here. And then on the right-hand side of this chart, you can see the red arrows all moving upwards. What that is actually emissions per dollar of revenue is increasing. So even though they start setting targets and disclosing more, still moving in, not yet in the right direction, but probably along the trend of probably following the trend of all the sort of companies in the region. So again, this is going to be a major challenge for these major energy companies in the region. Even industrial conglomerates, which in most cases are actually involved in less emissions intensive businesses. The challenge for some of them is that actually a lot of them, some of them actually own power plants and other heavy emission generation assets. So even some of these companies, like for instance San Miguel in the Philippines, very, very large emissions levels. And as you can see also on the right-hand side, the arrows, only a few of them actually moving in the right direction in terms of being able to generate revenue with lower emissions. So that's very important, not only just reducing emissions, but actually still being profitable and generating revenue while doing so. So that's an important indicator we should look at. So the last point I want to make is that it's important that when we talk about net zero and hitting goals, it is really an economy-wide effort and truly transformative. So it can't be sort of understated what that means. First of all, if you look at the left-hand side of that, the majority of the energy sources in Southeast Asia at the moment still come from fossil fuels. If all these companies want to reach their goals, we're going to need a lot more clean energy sources. Otherwise, there is no way. It's only as good as the supply that they get. So there's a huge investment opportunity that needs to take place there. And the second point is that, of course, it's not only just in one or two areas, it's across the whole economy. So it's not just power generation, but transport industry as well. In some countries, as you can see, like Thailand, for instance, transport emissions are almost as large as power sector emissions. So not only do you need to build more lower carbon power generation sources, we need to look at electric vehicles and other technologies as well. So it's sort of across the board, across the whole economy. A lot of solutions need to be deployed. That's sort of the end of this, but hope that gives you a bit of a view on where things are in Southeast Asia. I think probably the one key takeaway here is that a lot of things are moving in the right direction. If we track the indicators in Southeast Asia, following global indicators moving in the right direction, but still very much a long way to go, and much needs to be done within the next 10 years as well. So something that we need to really keep a close eye on. So thank you very much for listening. Navina, back to you.
Thank you so much for that, Justin. That was a great presentation. We do have one question, and it's probably a bit broader than what you were talking about, but I will ask you and also Sylvian to weigh in a bit later. So the participant has asked, what are the negative consequences that we need to be aware of when all these countries and companies are adopting ESG at this speed? Do you have a comment?
I think a quick thought is going back to the standards point. You all heard about greenwashing, right? And I think the idea is that everybody jumps on the bandwagon without really understanding what it means, without fully disclosing or actually, or even really, adjusting their businesses in a way that can, the business can actually thrive in this new environment. So that needs to be carefully thought about, right? So I think it's important for companies to actually understand what they're doing when they're disclosing data or trying to shift their business models to doing something that's less carbon intensive. Right.
Okay, great. Thank you for that. And thank you for joining us, Justin. I know you might have to drop off soon for another call, but thank you for joining us. And next up, I'm really pleased to welcome Sylvian Caro, who is Executive Director for Client Coverage for MSCI. And Sylvian will be covering the types of data needed by asset owners and asset managers, types and utility of data sets that are currently available, and how to use an external vendor to complement your in-house data. So Sylvian, over to you.
Thank you, Navina, and thanks to Arina and Justin for the great presentations. It's great to hear from other parties. So same, please let me know when you see my slides.
Yes, we can see.
Great. So in terms of the agenda today, I will share 3 points, mainly how to integrate ESG in the investment process using data, and then in the second part, a bit more about our ESG ratings, and third about climate solutions, because we all speak about net zero, which is key and Paris aligned, which I think would be also interesting for investors to hear about. So the question is from why to how. ESG in the past few years was why adopt ESG. Now we are beyond that stage, and we all recognize the importance of ESG in the investment process, and the actually the COVID-19 crisis has accelerated this trend. So because we saw better resilience with the high-rated company versus the lower-rated companies. So I will focus on how to implement ESG in the investment process. So I think here it's key to understand that at MSCI we have 3 main approaches to sustainable investing. So the first one is the one that we call on the left values investing. So this is where, as an investor, you will align your investment with your political, ethical, or religious values. So in here, investor will avoid, for example, companies that are have business involved in tobacco, alcohol, gambling, and you may also want to look at this similar to Sharia compliance, for example, investing. Then you would have in green the impact investing approach, which is where investments look at having a positive impact in the environment. So this would look at, for example, strategies such as promoting climate change or promoting gender diversity. On the right-hand side, you have Eag Integration. So here, the goal is to assess long-term financial risk and opportunities related to ESG issues. And really the goal here is to have ESG as a core component of building a resilient and sustainable portfolio. And you really want to hear the purpose is to enhance the long-term risk return of your portfolio, as well as mitigating reputational risk. So what we have seen in the past was mainly exclusion values approach, but now we see more and more this trend towards ESG integration, where you look at the financial risk, and then you would have maybe some more values approach. Here in practice, how you would integrate ESG in your investment strategy. So for example, if you are a portfolio manager and during your portfolio construction decision, so you may use the Esg Ratings. You would look at the underlying scores on the 3 pillars, E, S, and G, to do your security selections. Or you would also work on strategies to help improve ESG and reduce the risk. Again, if you have the goal to reduce the carbon footprint of your portfolio, then you can use carbon emissions data, fossil fuel, as well as set some type of policies. On the third approach, if you want to exclude activities that are, for example, involving controversial weapons, alcohol, tobacco, so we do have some screens that would enable you to screen out these companies, as well as Islamic screens, if you're going with the values approach in your portfolio construction. What we see more, and this was also mentioned by Arina, so it's the risk management teams looking at ESG. So what they will work with a certain threshold, and then they will go and discuss with the portfolio managers regarding some of the names they don't feel comfortable with, and they will ask the portfolio manager, for example, to explain why they are selecting this company, which, for example, may have a low rating or social controversies, for example. And what you can see here on the screen are examples of portfolio summary reports, which enable you to show for your portfolio what's the letter rating of your portfolio and how well you are compared to the benchmark. Do you have more leaders? Do you have more laggards? And also in terms of the reputational risk, how well your positions in terms of governance risk, as well as carbon risk. Something that is key, and as owners of capitals and also the asset managers, so what we see is that they are expected to use their stewardship and influence on the companies they own. So they want to have now this constructive dialogue with the issuers, and they want to go and improve and ask them to improve certain aspects, for example, on their E, S, and G pillar. So with the reports, they are now able to improve the engagement and kind of continue to invest in them. So in the past, there was a lot of trend regarding excluding the sin sectors and divesting, but now really the trend is about more engagement with the companies that they own. And I think these points were also mentioned by Arina and Justin, so definitely a trend here. I'll spend a bit of time on the Esg ratings to explain the approach. So our approach is looking at ESG from a risk factor perspective and to assess how companies are positioned to manage the risk and opportunities in a fast-changing world. So we use letter ratings from CCC to AAA, as you can see, and with, of course, the words being CCC and the leaders AAA. And our rating is a signal which would focus on the most financial material ESG risk factor and exposure. So rating is meant to be forward-looking. So it's meant to look at potential risks that a company may face in terms of ESG. And I'll mention about the alternative data to answer the questions that were asked before. So we do incorporate alternative data that are information about a company which is published by a source outside of the company. So we use them to deliver insights which are not captured with voluntary company disclosures. We also use them to identify unexplored risk and opportunities, as well as to create innovative signals. We also do use AI to increase the collection of the data, and these data are reviewed and validated by our teams of more than 200 analysts. So there's always analysts looking at the data and then being able to provide insights with the different reports. So with our ESG ratings, what we try to do is to respond to the 4 questions that you see on the screen, and the 4 steps that will follow our rating. So the first question is, how is the company governed? So we'll look at corporate governance as a starting point. We'll do a deep dive analysis of all the companies. We'll look at the ownership structure, the board composition in terms of gender diversity, for example, tenure of directors. We'll look at incentives and pay behavior. Question number 2. What risk does the company face? How exposed is it in its business model to the relevant short, medium, and long-term ESG risk? So to answer this question, we will look at the most relevant key issues or key factors for industry. For example, carbon emissions is a key issue that will be significant for the utilities, energy, and material sectors, but it will not be a key issue for financials. Privacy and data security will be a key issue for consumer discretionary sectors, as well as financial, for example. And we will also use our proprietary database of ESG risk factor. So question number 3, what does the company say? What is the strategy for managing this risk? What is their risk exposure and how they're responding to this risk? So to answer this question, we will look at the company's disclosure and the policies versus its industry peers. The 4th question is, what does the company do? So here we're looking at what evidence do we see that these risks are being managed? And to answer this question, this is where we use alternative data sources and to check really this evidence and that the companies are really doing what they're saying they do. Basically, is the company really walking the talk? So we often get the questions on the sources of data inputs and that flow into our ESG ratings. And again, this comes back to the question that was raised today. So first of all, we will look at what is publicly disclosed. So we will look at the company mandatory disclosures, as well as voluntary disclosures, such as 10K, sustainability reports, proxy reports. Then alternative data is a significant input to the ESG ratings model, and they will help solve the problem when, for example, there is not a self-disclosed sufficient information. And we also have this, for example, in the emerging markets, where there is less disclosure than in the developed markets. So to do so, we will collect the data from different sources that you can see on the screen. And for example, there will be in gray some microdata at segment or geographic level. We could be able to find information on facility locations, mine productions, and then we'll use government, NGO, different data sets. In red, for example, we'll be looking at more regulatory data sets, such as product recalls, consumer complaints. And we'll do also, of course, look at news and media if there, for example, there are some controversial incidents going on in the marketplace. So to summarize, we could say that 20% comes from mandatory company disclosure, 35% from voluntary company ESG disclosure, and the remaining 45% is alternative data. I like to show this slide because it's a good example of how we use alternative data. So if you look at the left-hand side and we're looking at a risk, the water risk a company is exposed in China, on the left you have if we use only what company disclosed. So we're able to assess the risk, which is 4.8, which is medium. On the right-hand side, it's a different view because this is where we are complementing our analysis by alternative data, and we use, for example, at satellite images to get more granularity on the regions as opposed to water risk key issues. And you can see from here that the score changes and that it goes, they have a higher risk exposure to water risk. So this is really important to show, you know, the different scoring or risk assessment that you may get with alternative data. Now going more into climate solutions. So we discussed about the rating. So I'll just start by this one saying that Justin discussed about net zero. So really, what is being net zero? So net zero means that you're aligned with the Paris Agreement, which is to limit the global warming to 2 degrees and preferably 1.5 degrees. So I know there are asset owners and asset managers in the audience. So and there are members of the Net Zero Alliance. And I think it's interesting to see here on the screen that there are a few actions that they will need to implement. I know it's small, but if you look at the bottom left corner of the quadrant, you see that they need to have interim targets, and this could be common across the different alliances. So the goal is not only to get to net zero by 2050, but you also need to have and set interim targets by 2025. And the second concept that is also is engagement. So there are not enough green companies actually at the moment to create a well-diversified portfolio by only divesting. So Alliance ask you to engage and not only divest. And for example, some give guidance to engage with the top issuers, top 20 issuers in your portfolio. Asset Manager Alliance also have the same engagement requirements to engage with the issuers, but also with the asset owner investor. So definitely investors will need solutions and tools to help them in their journey to reach the net zero goal by 2050 or before. So climate data can be complex. And at MSCI, we do have a good data set to help investors reach net zero and those who want to set their targets. So I know this is a busy slide, but what you need to understand is there are different themes going from the left. So you would have transition risk, green opportunities, physical risk, and temperature alignment. So the whole idea with transition risk is moving from a high carbon current world to a future low carbon world. So it's all about emissions. So what you can see at the very bottom of the screen with standardized basic data is what investors have been using for years already, like Scope 1 and Scope 2 emissions. But now we do have Scope 2 emissions in our database, and we can estimate for the whole universe. But you also need to look at what is the country doing and the policies that, for example, they have been setting in terms of the regulatory framework. So this net zero framework stress the need not only to decarbonize the portfolio and to de-risk it, but actually also to have a real world effect in terms of opportunities. So this is climate solutions. This is low carbon technology. Everything you can think of is green. So we have data around that too, which is coming from green patents, green CapEx data on utilities, sustainable impact metrics, looking at the share of green and brown revenues from different business activities. So this will sit under the green opportunities piece. The third pillar, so this is extreme weather, extreme heat, floods, hurricanes, tropical cyclones. So here we'll look at the company's facilities, individual factories, offices, and what's the cost the damage if there are flood in that facility, for example. So it's all about these extreme weather events and what's the cost associated if that event happens. Last but not least, so we have alignment. So this is all about the future direction of the portfolio. So the investor wants to be aligned with the 1.5-degree world. How do I get my portfolio? The constituency net, such as in 2050, the climate profile or the characteristics of my portfolio are consistent with a 1.5-degree world. So it's all about company targets, what they plan to do. So not only we have these data points and components that you see, but we also got the models that you can see in orange at the top of the slides. So these are sophisticated investment signals that will do the calculations for the investors and are useful, such as in reporting versus risk team or risk assessment, as well as regulatory disclosure versus talking with trustees and members. So this is the last slide. So we have three main signals. I will start from the right-hand side, the low carbon transition score. So these are simple measures. And in here, what we do is that we classify every company and they get bugged in 5 different categories. So there will be asset stranding, which is severe situation. So this could be like a coal company, oil company. Then you would have operational and product transition in terms of companies that have to transition their products away from oil and gas, for example, or their operations. Then you will have a lot of companies sitting in the middle, neutral, such as healthcare and financials, for example. And then the last category would be solutions. The company, for example, engaged in renewable energy. This is mostly used for portfolio constructions and asset allocation. Then in the middle, the climate value at risk. So this is a forward-looking risk matrix, which is looking at the cost at assets pricing. So how is the value of this bond, of this equity, of this portfolio going to change in the future if the world does X, if the world does Y, on physical and transition risk. So this is mainly used for risk management and scenario analysis. Implied temperature rise. So this is all about impact. So this will help clients, investors engage with the issuers. So they can look at the companies in the portfolios, the ones that have a high warming potential, and they can engage with them. So they will be looking at companies' targets and decarbonization plan. So it's good for impact. So it will answer the question as an investor, what is my portfolio doing to the world in terms of climate change? How is my portfolio contributing to the warming of the world? Whereas the climate VAR, it answered the questions as an investor, climate change is happening anyway, how does it impact my portfolio and affects the value of my investment? So this is really high level because we could speak for many long, but I would just like to conclude by saying that we cannot get to net zero without significant change in the economy, without significant change in the companies we're investing in. So all these data and solutions will help the investors that don't have many companies they can invest in today, but this will help them put in the plan the one they can invest in the future to get to net zero. So that's it for my section, Avina.
Thanks so much for that, Sylvia. That was a great presentation. I know we have run out of time, but we have one question which I think is quite interesting. You did mention in your presentation about controversial events and how that would affect a rating. So the question here is, if a company has a score, a AA score, and is experiencing a controversy in their business, so would the action differ depending on whether that issue is high in terms of materiality to them?
So that's a good question. So the way the controversies definitely enter into our ratings and they will impact the ratings. So company has AA and they say there's a lot of controversies in terms of labor management or an employer died an employee died in the facilities during this work. So it will definitely impact the rating. Regardless of the materiality, but this is something that will have a high impact. But in our ratings, we do have already built based on the materiality. So this will be already in account. And then on top of that, we will deduct points when there are controversies. So then the impact will be definitely there.
Okay, great. So thank you so much for that, Sylviane. And ladies and gentlemen, that wraps up our session for today. I hope you found this useful. And if you are interested in such events, the Sustainable Investment Platform does many of these events each year. So you just have to follow us on LinkedIn to be informed. So with that, I'd like to thank all my speakers again, Arina, Sylviane, and Justin. And thanks very much for tuning in. Goodbye.
Thank you. Thanks, everyone.